Operating Results Conference Call. All participants will be in listen-only mode. Should you need assistance, please signal a conference specialist by pressing the star key followed by zero. After today's presentation, there will be an opportunity to ask questions. To ask a question, you may press star, then one on a touch-tone phone. To withdraw your question, please press star, then two. Please note this event is being recorded. I would now like to turn the conference over to Julie Hasselwanderer, Senior Manager of Investor Relations at Realty Income. Please go ahead.
Thank you all for joining us today for Realty Income's fourth quarter operating results conference call. Discussing our results will be Sumit Roy, President and Chief Executive Officer, Christie Kelly, Executive Vice President, Chief Financial Officer and Treasurer, and Jonathan Pong, Senior Vice President, Head of Corporate Finance. During this conference call, we will make certain statements that may be considered forward-looking statements under federal securities law. The company's actual future results may differ significantly from the matters discussed in any forward-looking statements. We will disclose in greater detail the factors that may cause such differences in the company's Form 10-K. We will be observing a two-question limit during the Q&A portion of the call in order to give everyone the opportunity to participate. If you would like to ask additional questions, you may re-enter the queue. I will now turn the call over to our CEO, Sumit.
Thank you, Julie. Welcome, everyone. 2022 was a year of significant growth for our company. I would like to express my gratitude and appreciation to the Realty Income team, who have worked tirelessly to execute on our strategic objectives, and all of our investors for their support. The result of our team's collective efforts was reflected in our 2022 results, highlighted by AFFO per share growth of 9.2%, the highest annual growth rate for our company since 2013. Additionally, we closed on approximately $9 billion of high-quality investments in 2022, including $3.9 billion in the fourth quarter. Both the annual and fourth quarter investment volume set record highs for the company. Underpinning investment activity, transaction flow remains robust. We sourced $17 billion in the fourth quarter, bringing 2022 sourcing volume to $95 billion. Finally, we ended the year with occupancy of 99%, our highest occupancy rate at the end of a reporting period in over 20 years. At Realty Income, we strive to provide stability and sustainable growth on behalf of our investors. And during periods of economic uncertainty like we find ourselves in today, the resilience demonstrated by our business model is important to highlight. During our 28-year history as a public company, our combined total return, consisting of AFFO per share growth and dividend payments, generated by our operations, has not experienced a single year of downside volatility in the form of negative total returns. We believe we are in very limited company among companies in the S&P 500 who can make that claim. This is a testament to the durability of our underlying cash flows, which is supported by a diversified portfolio of properties under long-term leases with clients that are leaders in their respective industries. We are constantly working to incubate new swim lanes for growth that offer attractive risk-adjusted returns. Since the start of 2022, we have expanded our new verticals to our platform. In October, we completed our debut transaction in Italy, acquiring 7 wholesale clubs operated by Metro AG, an investment-grade pan-European leader in the wholesale club industry. As we discussed in 2019, when we purchased our first property internationally, we are intentional about consolidating the fragmented commercial real estate market in Europe, and Italy represents the third country abroad in which we now have a presence. In December, we closed our $1.7 billion acquisition of Encore Boston Harbor Resort and Casino from Wynn Resorts, which represent our first transaction in the gaming industry. The property is a good example of our strategy to partner with best-in-class operators to acquire high-quality real estate. It was purchased at a discount to estimated replacement cost, is subject to a long triple net lease of 30 years with attractive annual rent escalators, and is located on prime real estate with structural barriers to competition. As anticipated in August 2022, Massachusetts partially legalized professional and collegiate sports wagering for the state, unlocking an estimated $850 million of gross annual gaming revenue and further supporting the strategic importance of this asset. In addition, we are pleased to announce a significant investment in what we are calling the consumer center through the acquisition of a 224 property portfolio of dental practices during the fourth quarter. We expect this $520 million transaction to be just the start of additional investments we hope to make in a sector that we estimate has a total addressable market in the U.S. of nearly $1.8 trillion in real estate. We believe the consumer-centric medical industry shares many of the same attributes of the non-discretionary service-based uses that make up much of our portfolio and that have proven resilient throughout our company's long history. These locations offer essential goods and services in and around the major thoroughfares in which our assets are. For properties leased to clients in the consumer-centric medical industry is extremely fragmented, which creates consolidation opportunities we believe we are well suited to address. We believe this industry will continue to move towards a patient-centric model. The trend towards the outpatient model has been ongoing for decades, but we expect this shift to occur in an accelerated fashion post-pandemic and will manifest in several ways that support our investment in the industry. First, the convenience of having care delivered closer to the patient will increase accessibility to the patient and reduce costs for all, including patients, payers, and providers. Second, existing clients of ours like Walgreens and CVS will continue to disrupt the status quo as they gain an increasing share of primary care over time. And third, we believe these industry dynamics will help lower the per capita spend on healthcare in the U.S. and help improve the quality of outcomes. It is also important to note that the adjacency and fungibility of these assets are a strong fit with our existing footprint from a real estate standpoint. As we underwrote this industry, we conducted a study analyzing over 30,000 variables and found that our portfolio had a 90% similarity with a data set of assets in this industry, and we look forward to increasing our exposure over time. Moving on, as we announced earlier this week, actually yesterday, we have entered into a strategic alliance with Plenty, an emerging leader in vertical farms operations, to support the development of Plenty's indoor vertical farms. As the initial transaction of the alliance, we will fund the development of an indoor vertical farm asset near Richmond, Virginia, located adjacent to an Amazon distribution facility. Plenty's highly automated farming architecture efficiently harnesses scarce natural resources to generate production yields that it believes are up to 350 times greater per acre than conventional farming. We regard Plenty at the forefront of a structural evolution in crop production and growth plans. In summary, these distinct new verticals are representative of the growth opportunities we expect to unlock over time to create value for our shareholders. Moving on to our portfolio. In addition to our record occupancy at year-end, we are proud to have delivered a rent recapture rate of 103.8% during the fourth quarter on properties renewed or released, bringing our full-year recapture rate to 105.9%. We attribute these results to our proactive asset management efforts, the underlying quality of our real estate, and our rent levels in the portfolio relative to market. Despite our recent accomplishments, we are still working through the impact of the pending bankruptcy on our Cineworld exposure, which is 1.4% of our total portfolio annualized base rent. As a reminder, we own 41 assets, 17 of which are subject to a single master lease agreement, and 22 of which have been accounted for under cash basis accounting since the third quarter of 2020. Following the announcement of the Cineworld bankruptcy in September 2022, we have collected 100% of contractual rent in each month from October 2022 through February 2023. As resolution on the bankruptcy has not yet materialized, we deemed it appropriate to revisit we've had on our Cineworld receivables balance as we continue to evaluate the collectibility of these amounts. As a result of this analysis and in an abundance of caution, in the fourth quarter, we recorded $13.7 million of additional reserves associated with 9 Cineworld properties previously on accrual accounting. In total, we now have $35.6 million of cumulative reserves on 31 properties that are on cash basis accounting, representing approximately 70% of our outstanding receivables from Cineworld. As a result of these changes, our unreserved receivable outstanding from Cineworld was $15.6 million at year-end, excluding straight-line rent receivables and including both deferred contractual rent and deferred expense recoveries. The 31 properties on cash basis accounting currently account for approximately $2.6 million of monthly contractual base rent. Based on public information and our proprietary analysis, we continue to believe our portfolio of Cineworld assets is generally comprised of the stronger performers in the operator's portfolio, and we will provide an update on the outcome of our negotiations when appropriate. Finally, in January, we were pleased to welcome Greg White as Chief Operating Officer. The COO role has been vacant since 2018 when I assumed the role of CEO, and having known Greg for many years, I believe he has the experience, leadership qualities, and business acumen to add immediate value to the management team. Most recently, Greg served as a senior advisor in the real estate and lodging investment banking group at UBS Securities. I admire Greg's extensive knowledge of the commercial real estate space, and his thoughtfulness and integrity will mesh well with our culture at Realty Income. I will now pass the call off to Christy, who will further discuss results from the quarter.
Thank you, Sumit. Moving on to the balance sheet. As publicly disclosed, we've been quite active on the capital markets front. During the fourth quarter, we raised approximately $2 billion of equity proceeds, primarily through our ATM program. And when including equity sold in the first quarter of 2023, we currently have approximately $850 million of unsettled forward equity available for future issuance. Throughout 2022, we raised over $4.6 billion of gross equity proceeds at a weighted average price of $67.04, almost entirely through our ATM program. We ended the year with net debt to annualized adjusted EBITDAR in our targeted range at 5.5 times, or 5.3 times, giving effect to the annualization. Please note that these ratios do not reflect the outstanding equity forwards I referenced previously. Our capital market activities in the fourth quarter and in January were aimed at striking the right balance between terming out our short-term borrowings while providing us the flexibility to participate in a lower rate environment over the next 3 years. In addition to the 10-year, $750 million senior unsecured bond issuance we priced in October at an effective yield of 3.93%, in January, we executed a dual tranche $1.1 billion senior unsecured bond offering. The offering consisted of $500 million 3-year notes callable after 1 year and $600 million of 7-year notes. In conjunction with the 3-year note, we capitalized on an attractive window to swap our interest payments from a fixed to variable rate structure, which we expect will replace a portion of our existing variable rate exposure in the capital stack. After giving effect to the interest rate swap, we effectively locked in a variable rate spread of negative 3.5 basis points to SOFR, which represents estimated savings compared to our credit facility of over 85 basis points. It is important to note that the $500 million of variable rate exposure is expected to be in lieu of variable rate borrowings we would otherwise have outstanding on our revolver or on our commercial paper program. Lastly, in January, we closed on a new $1 billion multi-currency unsecured term loan with an initial tenor of 1 year and with 2 12-month extension options. In conjunction with closing of the term loan, we entered into a variable to fixed rate swap, resulting in an all-in effective yield of 5%. I would like to take a moment to say thank you to each of our lenders that participated. I would also like to make special mention of Jonathan Pong and Steve Bakke for their tireless efforts and leadership in delivering upon our capital market strategies. Moving on to guidance for 2023, we are initiating AFFO per share guidance of $3.93 to $4.03, representing 1.5% growth at the midpoint of the earnings range, and including our current dividend yield, a total operating return profile of circa 6%. Though the annualization of higher interest rates has moderated our expected growth rate for 2023, there is much to be optimistic about. The investment pipeline remains active. We continue to source investment opportunities across our target markets at accretive cap rates in the mid-6 to mid-7 range. As a result, we are introducing 2023 investment guidance of greater than $5 billion, and we will, of course, revisit this guidance each quarter as we gain incremental visibility to our transaction pipeline. Finally, as the monthly dividend company, an increasing monthly dividend remains central to our business model. We were pleased to have announced a dividend increase of 2.4% last week, which represents a 3.2% growth rate over the year-ago period. We remain proud to be one of only 3 REITs in the S&P 500 Dividend Aristocrats Index for having raised our dividend every year for over 25 consecutive years. With that, I would like to pass the call back to Sumit.
Thank you, Christy. In summary, our 2022 results demonstrated the capabilities of our platform and the competitive advantages afforded to us, given our size, scale, and access to capital. Over the long term, we believe stockholders will continue to benefit from the stability of our cash flows, as we have proven with our track record of consistently positive total returns. Finally, we believe there is significant runway for further growth in untapped industries, geographies. Forward to unlocking these opportunities over time. At this time, we can open it up for questions. Operator?
We will now begin the question and answer session. To ask a question, you may press star, then 1 on your touch-tone phone. If you are using a speakerphone, please pick up your handset before pressing the keys. If at any time your question has been addressed and you would like to withdraw your question, please press star and then 2. At this time, we will pause momentarily to assemble our roster. The first question comes from Josh Dennerlein with Bank of America. Please go ahead.
Yeah, hey guys, thanks for the time. I wanted to ask about the Plenty indoor farm deal. I guess, this is a new industry for you guys, as well as it seems like a relatively new industry in general. I guess, how did you guys get comfortable with underwriting the risks and outlook for indoor farming?
So, thanks for the question, Josh. Indoor farming, as part of the revolution that we are seeing in ag tech, is something that we've been looking at for the better part of a year now, and specifically working with Plenty to try to understand their technology and how they're going to play in the ecosystem in terms of delivering crops in a much, much more efficient manner than traditional farming. If you look at, ag tech, and you look at vertical farming within this space, this is estimated to be a $50 billion industry over the next few years. And Plenty has a very established position within this particular vertical. If you look at some of the sponsorship that they have, it's with companies like Walgreens, Albertsons, and Driscoll's. These are some of the largest grocers and providers of end product to grocery stores. And Walmart has also invested directly in this company, along with from which they're going to be served the end product. So they have a lot of institutional sponsorship. We've gotten to know the company very well, and at the end of the day, it's a $42 million investment in a very well located industrial location. Happens to be very adjacent to an Amazon box, and we felt very comfortable based on the risk-adjusted return profile across various different scenarios that this was going to be a solid real estate investment. Having said all of that, one of the phrase that was used internally, the cherry on the top, was the fact that this aligns with our value system as well. The value of giving more than we take. We genuinely believe that ag tech and vertical farming specifically is going to have a big role to play in a world that continues to be resource constrained, yield constrained, water constrained, and continued deficiency of arable land going forward. So for all of those reasons, we got very comfortable with Plenty as an operator, and more importantly, this particular vertical within ag tech as an industry to pursue.
And then could you maybe elaborate a little bit on like the returns and maybe the outlays? I know it's a $1 billion pipeline. Like, is that something you expect to kind of put out the door all this year, over the next 2, 3? And are you guys financing the equipment inside the warehouse? Just trying to get more color on the deal.
Sure. So we are a real estate company, Josh, first and foremost. So that's all we are going to be investing in. Any equipment, all of the technology, et cetera, that is Plenty's responsibility. And so none of the $42 million will go to
In the past, you sort of talked about sort of stress testing the tenants and feeling pretty good. Just outside of the movie theaters, just where is your head at in terms of potential recession and tenant health? Thanks.
That's a great question, Ron, especially entering into 2023 with so much uncertainty. Look, our biggest focus right now is on Cineworld and how that's going to, what that resolution is going to look like. I do believe that whatever that outcome is, it's going to play out within the next few months. It's been in bankruptcy now for the better part of 4 months, and we have been in negotiations with them, and we leave it at that. Outside of that, if you look at our overall, and again, this is something we share in the supplemental, our cash flow coverages, four-wall cash flow coverages, those have continued to trend up. Largely a function of some of our existing clients continuing to outperform. Companies like Albertsons, et cetera, have continued to generate EBITDA growth on a four-wall basis, and therefore those coverages have continued to improve. Some of the new transactions that we have entered into have very healthy four-wall coverage ratios. And this is, again, it very much ties in with the comment that I think it might have been Handel who was talking about, why are we doing so many non-investment grade? If you look at it from a real estate perspective and you suddenly have coverages north of 4 times, 5 times in sound businesses, but they don't have an investment grade rating given their size, those are businesses that we will pursue. And so that's the reason why our four-wall coverage ratios is now close to 2.9 times, and it was in the 2.5s about a year ago. So the health continues to be fairly good. If you look at what is there on our watch list, it's about 4% of our rent is on the tenant watch list. And as you can imagine, a lot of it is driven by the theater business. A lot of the theater assets are on our watch list. And in some cases, we also have, assets that may not have a credit issue, but there is a location risk associated with what will happen at the end of the lease term, given the changing demographics, changing competitive landscape, et cetera, et cetera. So that constitutes our 4%, which is slightly higher than what it was, a few quarters ago. And it's largely a function of, what's happening in the theater space and what we expect will happen in a continued high interest rate environment.
Great. And then my second question, just touching on gaming. Obviously the Encore deal closed. How's that going now that you have the assets? And more importantly, what's the pipeline look like? How are you guys thinking about doing more acquisitions in the gaming space? Thanks.
Yeah, so we were very proud to own, this beautiful asset in Boston. We just had a demonstration internally about, our presence on LinkedIn and Twitter. And when we posted the news release around, closing on this asset, we had a huge jump in followings. So clearly it was appreciated by the audience following Realty Income. And we are very proud to have this partnership with Wynn. They are great operators. They are, very good to sort of continue to understand and learn about this particular industry. And we hope to grow this industry. We didn't do this as a one-off opportunistic transaction. And, it's very much in line with looking for the best operators and, trying to get assets that are going to be, icons for the given operator, but even outside of that. And I think we have checked all of those boxes on the Boston asset. But, finding those types of assets will continue to be we are focused on. And as you can imagine, we have received several inbounds. But for a variety of reasons, we haven't, chosen to pursue them because they don't meet all of the attributes that we are looking for. So we will be selective in this industry, but we would absolutely love to grow it over time.
Great. Thanks so much.
Sure, Ron.
Our next question comes from Wes Golladay with Baird. Please go ahead.
Hey everyone, I hope everyone's doing well. There's been a lot of M&A activity in the value-based care, so I was wondering if this is the industry you're referring to where you see all the opportunity, and if so, would you get the parents credit on some of these deals?
End up looking at Oak Street Health, for instance, that CVS ended up buying, and they want to monetize some of those real estate, then yes, by default, we are going to ask for CVS's credit, on this $10 billion transaction that they just consummated. Walgreens has done a similar transaction. Amazon just announced that they did a similar transaction. Yes, it is precisely what we are talking about. We are calling it consumer-centric because we are approaching it from a pure real estate perspective and trying to find, what are the alternatives of the locations that we have already, and what are the synergies with this new vertical that we are pursuing. It's certainly not looking at what traditional healthcare companies are focused on. That's not our forte. That's not our strength, and that has really no interest to us today. But it is the value-based healthcare that a lot of forward-thinking healthcare companies, healthcare operators are pursuing. And, the derivative of that will be the real estate. It could be, our existing, pharmacies that are going to be repositioned to health hubs and minute clinics. That's already happening. There's continued enhancement. There's continued, higher impediments to switching costs that are getting created. Those are all perfect for us. That's embedded value that doesn't get realized day one, but we love to see that happen, and we also want to be intentional about growing the portfolio by doing the types of transactions that we did in the fourth quarter in this particular area because we do believe in it.
Yeah, and then would you have, I guess, a lot of ground-up development opportunities, and then also it sounds like you'd have some redevelopment opportunities. Have you ever done redevelopment funding before, or is that a big part of the business now?
We've certainly done redevelopment funding, Wes. If you look at our pipeline, dollars today, and some of that is repositioning of our existing assets, and we've done some in-house. We've done a lot of it with partners, national partners that we have, and those have been some of the best recapture rates that we have achieved in our portfolio. So, when we talk about this 90% overlap in terms of real estate characteristics of the locations that we currently own, and some of these consumer-centric medical concepts, that certainly lends itself to repositioning some of our assets for highest and best use. And we define highest and best use in terms of rent per square foot that we could recapture for a given location that we already own. And so, yes, I'd hope to be able to, partner with these operators, show some of our existing vacancies, potential vacancies that are going to come down the pike, and reposition these locations to help provide these types of services. So yes, that is absolutely a value enhancing proposition that we're going to explore.
Okay, thanks for the time.
Sure.
Our next question comes from Michael Goldsmith with UBS. Please go ahead.
Good afternoon. Thanks a lot for taking my questions. Can you talk about your view on interest rates in the capital markets based on your recent capital raising activities? Seems that Jonathan and Steve were busy with several, less traditional items with the term loan with multiple extensions and the callable unsecured. Just trying to get a sense of what you're trying to achieve based on the laddering with these instruments.
Hey, Michael, it's Jonathan. I would say the activities that we did in January, early January, it's all about financial flexibility. We, if you'll notice, did a 3-year non-call one, giving us that flexibility after 1 year to call at par. We also did a 1-year term loan, but with 2 1-year extension options. And so, what we're trying to avoid, especially since we went long on the curve earlier in 2022 with our debt capital raising efforts, was to lock in rates that, at these levels are very attractive to us. We would like to think that over the next 3 years, there will be a more advantageous window for us to tap into the debt capital markets to term these amounts out. And so it's really about, maybe a little bit of barbell, given the activity we did earlier in the year, much lower long-term rates, but also, terming out the revolver to an extent and creating that flexibility for us to participate in lower rates if they come.
Thanks for that, Jonathan. And my second question, we've talked about each of the new verticals in depth, but just wanted to talk about the big picture associated with this. Is this a function of something has fundamentally changed with kind of the traditional core retail assets or industrial assets that you are known for? And I guess, does these new opportunities provide more confidence in your ability to consistently hit or exceed the $5 billion of acquisitions that you've guided to the last couple of years? Thanks.
That's a very good question, Michael. It's a question that we've asked ourselves. There is a traditional definition of what a net lease company does, and yes, we can certainly be mandated and dictated by that. Or there was a way for us to step back and say, look, if we look at Realty Income, what is our core strength today? Our size and scale, which people have continued to point to as impediments to growth. If you look at the last 4 years, we've grown our business at 5% CAGR annually. And if you look at the business, this question has been asked for the last 10 years. We are going to take what has been used by the street as an impediment and see if we can garner value for us shareholders. And let's just ask the question, what is it that we can do with the core strength of size, scale, cost of capital that will be difficult for other companies to follow? And if the answer was, sorry, you're constrained by your business model and this is all you should do and this is all you can do, that would have been the answer. But what we found once we started to ask the question around redefining this particular space is that there's plenty for us to do. And we are only constrained by our ability to be creative. And ultimately, if we continue to underwrite these verticals and look at it from the perspective of real estate and look at it from the perspective of a net lease, suddenly, the answers that start to pop up are very different. And it allows you to do things and allows you to be very creative and create outsized returns for our shareholders that, with due respect, a lot of our peers are going to struggle trying to mimic. They just don't have the scale. And so if we can help consolidate real estate through a net lease structure, that is really the only governing principle that should be constraining us. And ultimately be able to show to the shareholders that on a risk-adjusted return, these are as safe, if not in some cases safer, than investing in traditional retail net lease businesses, then it's a win-win. So that's how we are thinking about the business, Michael. And, you'll continue to see us be very creative. But like I've always done, and like this team here has always done, we will engage with you to share our thesis. And by the way, I do highly encourage everyone to go to the new deck, the investor deck, where we've laid out our thesis in more detail, and you'll see some numbers around. And you'll find that this is what I think people invest in Realty Income for, and we are just delivering on that promise.
Thank you very much for that. Good luck in 2023.
Thank you.
Our next question comes from John Massocca with Landenberg Thalmann. Please go ahead.
Good afternoon.
Hello.
So, not reaching about the hour mark here, so I'll take us back to the beginning a little bit. As we think about the delta in the Plenty transaction between the $42 million committed for the Virginia project and the $1 billion headline opportunity, do you have some kind of like right of first refusal or purchase option to kind of get to that higher number? Just trying to kind of figure out what's in the remaining amount beyond the $42 million for the actual project that's underway.
So, John, the best way to answer that is any real estate development outside of a carve-out for one particular client that I mentioned already, which is a user of their end product. We basically get to take a look at the opportunity, and and then if we wish not to pursue it, we don't have to. But we, as their real estate partner, will be given the opportunity to look at any real estate development that they enter into, over the next 5 or 6 years. There's a time frame associated with that. But ultimately, the goal here is to continue to invest, because that would mean that they are becoming a more and more, successful operator within vertical farming, and we are their real estate partner going forward. But yes, so it is a concept of the optionality lies with us in terms of how much more we invest.
Okay, understood. And then can you provide a little more color on the dental portfolio acquired in 4Q? What made that specific portfolio attractive? And can you provide some color on the credit behind those assets?
So it's not rated. It was a situation where you had, the operator owned both the operations as well as the real estate, and this was a mechanism for them to monetize their real estate and continue to invest in the operations of the business. I think we are very constrained by what it is that we can share. This was a highly negotiated transaction, but it is one that we are very excited about. And, this is, again, an advent into this consumer-centric medical real estate in a big way. And we felt like it was large enough for us to sort of engage in and talk about. But we can't be more specific than that. You know what our overall cap rate was for the quarter. And, this was a very small component of it, given that it was a $4 million quarter. But that's the extent of what we can talk about.
Yep, that's fair. Thank you very much.
Thank you.
Our next question comes from Linda Tsai with Jefferies. Please go ahead.
Hi. What are some of the benefits you hope to achieve by filling in the vacant role of the COO?
Greg's sitting right here, and he's already, he's been with us about a month and a half, and he's already added so much value to all of our discussions. It's a very bright mind, and now he's going to start blushing. But he's somebody that I've respected. I've known Greg for the last, I guess now it's almost 15 years. And he has a perspective that he brings to the table that is very unique, and is going to be incredibly additive to all of us. Look, our business is becoming more and more complicated. We are becoming a bigger and bigger organization. We need talented people to continue to be that. But the most important thing about Greg, in my mind, is his integrity and his ability to, and his leadership qualities and his ability to mentor. Those are all qualities that will be put to good use, especially with the next batch of leaders that we are cultivating internally. And he will be a massive help in accelerating them to very senior leadership positions within the company, which, by the way, this company will need in order to continue to execute its strategy and plan.
Thanks for that. And then just in terms of recurring Capex being less than 1% of Realty Incomes NOI, Does this vary whether the properties are domestic or international? And are your new verticals consistent with this threshold too?
It depends on the type of leases that we have. I will tell you that, for example, an industrial lease tends to have structural and roof responsibilities. That's on the landlord, and so obviously Capex there, not maintenance Capex necessarily, but just Capex in general, is going to be higher. Now, some of it will be viewed as maintenance, some of it will be viewed as improving the life of the real estate. So the categorization of that Capex may be different, but it is very much a function of the lease. I would say that in the UK, there is, even on the retail side, there is not perfectly what we call quad nets assets. So we do have a lot more leakage, but a lot more leakage is a relative term to very little leakage here in the U.S. And so all said and done, it's not a big part of our business. It's something that we share. It's part of the AFFO. And again, all of that is underwritten when we are thinking about the long-term return profile of investments that we make. Obviously, take into consideration on the front end before moving forward in transactions.
Thank you.
Thank you.
Our next question comes from Tayo Okusanya with Credit Suisse. Please go ahead.
Yes, good afternoon. Just a quick follow-up on Handel's question. So again, doing a little bit more in the non-IG space, your watch list is a little bit bigger. On the flip side, your rent coverages are getting stronger and stronger. How do we think about just kind of credit provisioning on a going forward basis with all these kind of moving factors? And what do you kind of look at as kind of adequate provisioning relative to historical levels, just kind of given the business backdrop?
Yeah, Tayo, it's not a perfect science. You've put forth two data points that we've shared with you that are polar opposites. How in this backdrop of uncertainty do we have four-wall coverages that continue to improve? Yet, we are doing less and less of investment grade. But that goes back to the underwriting, and I already mentioned to you that there are a couple of retail names that, are not investment grade, but have coverages, north of 5 times. And again, it's a question of, are these businesses that we are comfortable with the backdrop of this high interest rate environment? We are not going to be doing transactions where, you're going to have an operator that doesn't have a business model that can sustain what we are going to experience, especially in the near term, because that would not be good. So I don't think we should over-index to investment grade. I know it makes the conversation so much easier with the outside world, but what we have to rely upon is where can we get return profiles is superior to alternatives. And I think that's how we are thinking about our business. We clearly have provisioned because of this uncertainty. We clearly have provisioned in our guidance, a higher bad debt expense. But last year was a phenomenal year for us. We had a similar provisioning that we kept adjusting throughout the year and ended up actually having bad debt expense below what we have traditionally experienced in the business. So again, we expect the worst. We underwrite to what we expect, and allow for the better outcomes to play out. And that's really how we think about our business, Tayo.
Gotcha. Could you share any specific numbers about the provisioning, like 60 basis points or 75 basis points as the bogey?
You mean in terms of what we have in the earnings guidance?
And the guidance, yeah, and the guidance.
Yeah, I don't think we're going to give that level of guidance because guess what's going to happen, Tayo? every year subsequent to this, people are going to want to know that. Just take a look at our history. You've got bad debt expense. It's an income statement line item. You can take a look at the history, and you can see that, historically speaking, we've been in this 20 to 20 zip code. And, last year was better than that. So, you can now take that information, overlay what we expect to happen over the next 12 months, and that's how you should create your models.
Fair enough. Thank you.
Sure.
Our next question comes from Josh Dennerlein with Bank of America. Please go ahead.
Yeah, hey guys. Just one more. Just on the tenant front, I don't think we touched the watch list. Saw some news on kind of, or the Red Lobster's been in the news. I guess they've closed a few stores. Any kind of updates on the watch list and maybe just Red Lobster in general?
You missed it. Somebody else asked us about the watch list. It's right around 4%. You brought up Red Lobster. There were rumors around that Red Lobster was trying to negotiate rents with landlords. I can unequivocally tell you that that is not the case. At least they haven't approached us. There certainly was, assets that they have closed again, none of which impacted our portfolio. And there are some challenges with that operation. It represents about 1% of our rent. But again, I do think that some of the missteps that they had made in the third, fourth quarter of last year have essentially been reversed. They were slow to make pricing adjustments. They have rectified that. And they are managing their inventory much better. And all of those should result in, better performance. But I just wanted to make sure that we were talking about facts and not rumors that have, percolated in the rumor mill.
Well, thanks for the update.
Of course. Thank you.
This concludes our question and answer session. I would like to turn the conference over to Sumit Roy for any closing remarks.
Well, thank you, Dave, for hosting us, and thank you everyone for joining in. I look forward to seeing you guys in the upcoming conferences. Take care.
The conference has now concluded.